Okay, we're going to start off straight in with our fund managers panel. Buy, sell or hold, appetite, investment criteria, mining market trends in 2019 to 2020. We're delighted to welcome a fantastic lineup of panelists for you this morning. We have, if they could join us on stage, Julian Babarczy, who is portfolio manager at Regal Funds Management. We have Andrew Ferrier, investment director at Pacific Road Capital. Matt Griffin, co-portfolio manager at AMP Capital. And flown up fresh from Melbourne, we have Rick Squire, portfolio manager at Acorn Capital. Can I have a big round of applause for our panelists? Fantastic. Now, I will be asking the audience for questions for our panelists later on in the session. Do we have any questions to kick things off? No, good. Okay. I tried that one in New York and someone stuck their hand straight up and started asking a question, so I'm glad that because I've got some questions here to ask. So, gentlemen, welcome to the conference. We're setting the scene with this opening panel. We're just going to sort of discuss what are people's appetites for the market at the moment. So, if we start at this end, Julian, how are you feeling about the mining market at the moment? What are the sort of valuations and state of capital raisings telling us about where we are in the cycle?
Sure. Thanks, Leo. Is that one on?
Yeah.
Yeah. Look, I think it's an interesting time for the markets. To be fair, I think it's hard to say that all the commodities are moving in with any sort of synchrony. I think what we're seeing is we've got a gold market that's gone very well for a period of time, and there's a bit more skepticism coming into that now after a big run. But clearly, profits are still very good at gold stocks. So it's quite an exciting sector. You've had some of the bulks run very hard a while back and have since come back to earth with coking coal and iron ore coming back. You've had things like battery minerals, which have been broadly in the toilet for the last couple of years, and so I think it's hard to give one broad brush. I think it's very commodity selective, and I think in terms of the capital raisings we're seeing, there is a market for companies to raise capital. It's not as easy as perhaps times in previous years. I think there's a lot of decent projects out there, but well and truly, I think the scene has been set by the big mining companies, particularly, who are very much focused on capital efficiency, on projects that are fundable. And so I think for the smaller guys to have projects that can actually be achievable in the current market is the most important thing. So I think the days at the moment of the billion-dollar capex projects getting up are very, very difficult. I think companies that can distill maybe a larger project into smaller bite-sized chunks, raise capital for those, and almost grow it organically, and preserve that optionality for the big project down the track when commodity prices improve. I think the macro generally has been a headwind rather than a tailwind. You've had the China and US trade war, which clearly is having a huge impact on commodity prices, mostly the base metals. And I think in that context, investors have generally been pretty sceptical, albeit there's been some supply disruptions in things like iron ore and the like. So, look, without really giving you a solid answer there, I think it's very, very stock specific. It's very, very commodity specific. But overall, it's quite it's a difficult environment, I think, to raise capital for projects. But the contrarian in me also thinks that it's probably the right time to be looking at projects now, because if we know anything, it's that the mining is a highly cyclical industry and market. And the best time to be looking is when no one wants to own these things. And that definitely means to me that we should be looking at some of the things that are very unloved at the moment.
But we're seeing possibly a bit of a thaw in the trade war. We're heading into an election year. People usually predict that, things go well in an election year, and Trump will not want to have the economy struggling as he goes for re-election. Is it the market, though, ready now for a rebound, do you think?
Look, I would have thought so. I would have thought there's been a fair bit of destocking in lots of different commodities, so I don't think the supply chain across the board is particularly bulging. I think you're right. I think Trump needs to get a solution so he can get himself re-elected. I think China definitely needs a solution as well, because their economy is hardly doing fantastically either at the moment. So I think there's a lot of common will to get a deal done. I think that will really help the sentiment and also the actual trade flows in commodities. So, I'm quietly optimistic about next year for the commodity markets, because I think some of the issues that have been plaguing the industry for the last 12 to 18 months could eventually be in the rearview mirror.
Rick, let's go down your end of the line.
Yeah, sure. I agree largely with what Julian's saying. With the commodities, gold is the classic defensive stock that we look at when we put in our portfolio. So it's something we think about a lot. And in terms of the trade war, I'm a little bit more cautious that there'll be a resolution. We're talking about a staged resolution now, and anyone that thinks it's going to be a quick and easy fix is essentially trying to be a mind reader for Donald Trump. That who knows what he's going to do. So I see the resolution as something that's going to take years, and there'll be a lot of back and forth. And for that reason, I still remain optimistic on gold, just because of the uncertainty that's going to come from the outcome of these trade negotiations. That sure there'll be an improvement for today, but it's not going to be a solution. And so I still see some optimism there in gold. In terms of how you position for that, the thing that I really like about gold at the moment is that a lot of juniors, for the first time in years, have actually managed to raise quite a bit of capital in the middle of this year. And so we should see over the next probably 6 to 12 months a lot of drilling that's going to happen that just hasn't happened for probably 6 or 8 years. And there's really good potential for discovery. So, and with that, if we do get some discovery, there'll be some momentum that comes off the back of that. So, if you look back over the last 10 months, we saw the Aussie gold producers run really hard, sort of from Christmas into early this year, and then their valuations got a little bit lofty, and there was some cycling down. Some of the clever investors cycled out of them into the US dollar exposed gold producers. So they were companies like Alasa or the African producers who all their cost base is essentially in US dollars, and so we saw those ones were the next lot to run off. And now with the handful of small exceptions, we're seeing across the board there's pretty lofty valuations there in the gold. So the next phase was the explorers. Now you're changing your risk profile as you move into the explorers, but there are actually some very good explorers with very good projects, and finally got a decent amount of capital to do some solid work. And so if you pick carefully, there's pretty good opportunity there. So gold's something that I still quite like, and we're not heavily tilted in that direction, but we've got very solid exposure as pretty much like a insurance policy in terms of how we view the portfolio construction. And then moving into the other base metals and battery metals, as Julian said, the battery metals have been in the toilet for a couple of years, but now we're actually starting to see real value. That some of them are heavily levered and are in quite a precarious position, but others are not. And so there's real opportunity there, I think, in terms of that those particularly lithium, but also in copper. So I think there's some real opportunity. So we're actually pretty optimistic that it's a good time to be there, because you can never pick the bottom, but you've got to be around there about that time.
And Acorn Capital, what stage in the market do you invest in? What size of company typically?
So at Acorn, we look for we invest outside of the top 250 on the ASX. So at the moment, that's companies with market caps less than about 900 million. So when I'm making all my comments, it's prefaced in the context of companies up to about $1 billion market cap. So we start around about 20 million is where we'd get in. Just in terms of minimum investment size, what we can actually get into, and then we'll go up to there, and then the idea is then we'd cycle out and come back down. So we do like the explorers, but we haven't invested a lot in the explorers over the last couple of years, just because when they've got no capital, they're not doing any work, there's no reason to be there. So that's been a real problem for us. So we've been playing outside of our usual comfort zone for that reason. But now we're actually quite optimistic that there's opportunity in that explorer space, and you can see it in the market that it's amazing that the gold price is at $2,300, $2,200. and there's like one development project out there. There's West African Resources. It's absurd. And you've got Capricorn, who will soon get their debt and will become the second one. So how can it be that you're at this all-time high, and there's one African project that's in development? And when you look at the ASX, it's an absurdity. Yet that's a reflection of the absence of capital into that exploration space, and that's going to. I think that's changing now.
But now some of these guys have got cash. It must be an exciting time for you to get back in there and be waiting for these results to come out over the next.
Yeah, definitely. So that's why we're quite excited, because that's the space that we play in, and you know, we're very active and looking around. So hopefully we can have some success.
Perfect. Andrew, let's come back over this side. Tell us, Pack Road. You know, at a time when juniors are finding it hard to raise capital, private equity has an opportunity to make hay, I guess, in that space.
We do. We're obviously very selective also about what stage we invest into certain projects. I think historically, putting projects through the development curve, through permitting, through a DFS into construction has been a poor return on capital. I think that still weighs heavily on a lot of investors' minds. And that's part of the reason, as Rick pointed out, there's such a lack of development stories out there. One of them is there's just been no exploration to find them. The second point is that there's no capital to fund them, because historically it's just been a very, very poor bet. At Pacific Road, we're far more focused on funding projects which are very near-term revenue. So look at construction equity, look at refinancing debt, look at M&A opportunities, trying to deploy $80 to $100 million into each investment that we make. So we're a lot more chunky, sizable bets, and we have a hold period of 4 to 5 years. So we're very focused on not what essentially the world looks like today, but what will the world in that underlying commodity we're investing in look like in 4 or 5 years when we have to sell the project to someone else. So that makes it difficult with things like battery metals. That's why we steer clear of lithium, because we just couldn't get an accurate, I couldn't get an accurate feel for what the supply response was going to be. And as we found out, the supply response was actually pretty impressive. And that's why we're in the position we are in today. Fundamental in every investment we make, though, is outside the project and what is the management team. Because we've seen over the years that management teams can create and destroy value at the click of their fingers. So that's probably the largest part of our due diligence these days. And that all links into ESG and how they view the world in terms of best practice, which is an important thing for us to have a conversation with before we make the investment. And in terms of commodity selection, I think we're happy to do more gold. I'm fairly pessimistic on the world over the next 12 to 18 months. I know the norms are that economies should be primed before election cycles, but I'm just not sure if norms apply anymore these days. So I'd still be in gold. I'd be hesitant about Aussie gold equities. I'd be looking elsewhere, just because of valuations. And then we're always looking for good industrial minerals projects, largely because they're probably misunderstood by the public markets. So historically, we're invested in a wide range of things, from diamonds to mineral sands to bauxite, and we were happy to continue to do that. So yeah, it's good hunting out there, but you've got to be very selective.
And Matt, you look after smaller companies at AMP. How are you feeling about the situation?
Yeah, so our fund is a mix of industrials and resources, so we sort of look across the small cap space. I'd echo the comments that these guys have made. You've got to be very selective out there in terms of both commodities and projects and companies. It is a very difficult macro backdrop. I think one of the things we're seeing investors pay up for in this environment is a strong balance sheet. You know, it's difficult for companies to raise money out there, and having that cash and the flexibility and the optionality that gives you in this environment is crucial. Especially some of the smaller guys, you know, getting capital raisings away just to pay for exploration or pay to keep the lights on is a very difficult proposition. There's money out there for good projects and good companies and good management teams, but it is a very, very difficult environment down at the smaller end. So for us, we sort of focus above the $100 million range. We don't go too small or too early. We need to have line of sight on earnings coming through in the next few years. And typically what we look for in a company is we're less on the macro, so we don't as long as we're comfortable enough with the commodity, we're looking for companies which can add value in a flat commodity environment. So we're not out there saying we like, we particularly like copper or nickel or something like that, and we're just picking a basket of companies that will give us exposure to that theme. What we're looking for is companies where we can see upside to what the market's factoring in, either through their own organic growth profile or costs or new projects or something like that. So we're bottom-up fundamental guys, and that's sort of our focus.
How far from production would the company need to be?
We've got a mix. I mean, typically we want to see at least a resource and be able to wrap some numbers around that. We won't go into pure greenfield exploration companies, so we'd like to see cash flow within sort of 2 or 3 years. But we do have a mix in the portfolio of things at that resource stage all the way through to producers.
But right now, where we've got explorers who do have some cash and their drills are starting to turn again, are you looking down into that space?
We are. An example is something which already has a mine and has brownfield exploration or a potential new project. We're not going to pure greenfield explorers. Our investment process is very earnings focused. So if we can't see a clear sort of pathway to earnings, despite how prospective the ground might be, we just tend to steer clear of that space.
So let's talk a little bit about commodities. I mean, people have mentioned gold. Obviously, it's been an up and then slightly down year. Battery metals have been mentioned. But what are people's top picks, do we think, for sort of the year ahead? Julian, what are your thoughts on that?
Well, I guess ultimately being a bit of a contrarian, I think the battery minerals are one of the ones where I've done a lot of work previously. Hasn't necessarily been good hunting ground the last couple of years. It's actually been horrible hunting ground, to be frank. And I think I've spoken at a bunch of conferences and have been wildly incorrect on this call for the last couple of years, so I'm going to stick to it. And I think lithium's going to have, a fantastic next couple of years, in my view. I think the demand side is coming. It's very rare to find a commodity where, even according to the bearish analysts, it needs probably 3 times growth over the next 7 or 8 years. At the upside, probably 5 times growth. I've never invested in a commodity that's had that sort of demand profile coming. I think we're seeing a lot of supply discipline. We're seeing, especially the spodumene guys shutting in production or some going broke. You've seen a lot of supply growth that's been slated for the next couple of years that's been put on hold. You've seen a price now well below 10,000, so it's not incentivising new capacity or new funding that's required many years before the capacity comes online. And so I think it's setting up for another price boom in the next 5 years. When that kicks in is really hard to tell, but then on the demand front, clearly China has dominated the demand side of the EV revolution in the last 5 or so years. They've had subsidy changes. I think the market isn't looking at that in a very nuanced way. They think that's the only lever they've got. They're actually using many other levers, and they still want EV penetration much higher. So I think the Chinese, after going through a slow patch, will incentivise that demand and the end user to buy EVs ultimately as well. You've also got the rest of the world who's becoming a fast follower. I think there's only 20 or 30 pure electric vehicle models on the planet today. Most people expect there to be probably 250 in the next couple of years. And so for me, consumer choice is going to be there. I think previously it hasn't been. So when people are buying their next car in a couple of years' time, I think they'll have a lot more choice. And so rather than just buying an expensive Tesla, you'll have some really solid lower and mid-range models to choose from. I saw on the TV advertised on the weekend the Hyundai new fully EV that looks like one of their old ones and probably drives a lot better. So I think for me, lithium's a really exciting part. Interestingly, I'm not a chartist, but I think you've seen the lithium ETF appears to have bottomed. It's rallied about 30% off its lows. You've got stocks like Ganfeng, which have rallied anywhere between probably 70 or 80% in the last 5 months. Most of the US stocks have been in trouble as well over the last couple of years. They definitely seem to have bottomed also. And even with Livent last week announcing a downgrade, the stock rallied on that news. So you've got share registers that are highly shorted still. You've got the marginal seller's hard to find, I think, in that space. And I think the world will be underweight when the demand comes through. So lithium's exciting. Graphite's been a horrible one. For us, we still hold Syra, and that's been just a litany of downgrades and disasters. They've brought in far too much of the supply into the market. They're now winding that back, and I think we'll know in the next 12 months whether there is a market for their graphite, because if they pull that out of the market and the graphite price doesn't rally, then I think the whole dream's probably been an epiphany. or a Mirage. So look, graphite, I've got to stick to my guns there as well, and I think that on the back of the EV penetration that you'll see more demand for that as well. Cobalt's been difficult, and there's a lot of attempts to engineer that out of future batteries, although I think it's going to take longer than what people think. Although that's one commodity where I think the supply response is a bit easier than what other commodities might be. And then you've clearly got nickel, which wasn't a battery mineral 2 years ago and now is seen as one of the shining lights, and I think that's a genuine demand story as well. So there are some commodities that get me excited. I think coking coal's another one to change tack as well. Coking coal looks interesting. Still growth, I think, will continue to be strong. High quality coking coal's hard to find, and we've been doing a lot of hunting. We can actually invest in unlisted companies as well. We've been doing a lot of investing in the Canadian coking coal basins, the new one near where Gina acquired Riversdale in. So I think that'll be the next basin, and there's some very exciting exposures we've built there. And so that's probably the top list of my commodities we're looking at.
Fantastic. Andrew, Julian there said he likes battery materials. You said you didn't like them earlier. Why is he wrong?
Let me try and restate that slightly differently. Look, when we look at the EV thematic, the battery thematic going forward, I think we'll look more closely at nickel and copper, the larger sort of commodities. We believe the demand side on nickel. We think that's going to be real. How to play that, how to find a good sulfide project is absolute key. You've seen IGO and Panoramic in the last week or two. Copper, as always, trading below $3 makes no sense in the long term. Finding a good copper project, though, is very, very difficult. And when we look at the broader spectrum of commodities, I look at silver as particularly unfancy and unloved at the moment. And trading at a gold-silver ratio of 80 to 85 today, I don't think is going to be the norm going forward, and some reversion to the mean may take place. And anything that you look at someone, you say silver, and they just get bored instantly, you know that's probably going to be a good investment over the next couple of years. We look at weird and wonderful stuff as well. So we're focused on diamonds at the moment. We think no one pays attention to diamonds, but rough diamond prices are at all-time lows, and so there's money to be made there. Hopefully over the next 3 to 5 years. High-quality coking coal is obviously extremely valuable. We've also invested heavily into the Elk Valley in British Columbia, so we see that being a very good place to be over the next coming years. Just can't be, taken out of the market. We'll always trade at a good premium price. So that's essentially what we're looking for. We just are nervous about the smaller sort of market-sized commodities in the EV space. They're just so easily impacted by a sizable project coming on. So that just makes it hard to get your forecast correct, and that can work both ways. It can be spectacularly right and can be spectacularly wrong. So you can take on that risk, and that's no problems, but we're just longer-term investors, so it obviously means a little bit more to us. We can't just wake up one day and say, oh, got the supply response wrong, let's trade out. We're in it for the long term, and we need to see it to an exit, and we usually need to find a pretty material buyer for our position. So we just think about things slightly different in terms of investment style. Absolutely.
Matt, what are your thoughts? Commodities.
Yes, I've probably been a bit early on this call, but I think the one for me over the medium term is uranium. It's hard to pick when it's going to happen, but I think over sort of a 3-year view, there's a huge amount of upside to uranium prices. It's an interesting dynamic. I mean, the demand side is okay. It's growing slowly. It's mainly driven by China and a few developing economies, with the Western world maybe switching off a few reactors. But this really is a supply story. So we've seen a huge amount of supply come out of the market. Cameco shut down production. Paladin has, the Kazakhstanis have also pulled back on their growth plans. There's now a huge supply gap there, and it's just a matter of sort of waiting for stockpiles to be drawn down to a point where we see a price reaction. We sort of know from what Cameco is saying, and they need to step into the market in a big way in 2020 and buy quite a lot of pounds. It doesn't seem like there's a huge amount of spare stockpiles out there. We've got quite a few companies out there as well on the investment side, so Yellowcake and Uranium Participation, building up stocks as financial players. So again, it's a pretty opaque market, and it's quite hard to sort of tell when that turning point is. But with spot price at $25 and term prices, say $32, you probably need $40 to $50 to at least incentivize some of this production to come back in the market. And you're sort of closer to $60 to start up new mines. So it's quite an easy path to see uranium prices sort of doubling over the next 2 or 3 years.
Why hasn't there been a supply response, price response though?
Yeah, I think there's been a lot of uncertainty in the market. So you've had the US S-232, which is Trump looking at sort of imports into the market. The US utilities, who we know have a decent amount of contract coverage over the next couple of years, but they're going to have to come back in the market and start setting up new term contracts sort of over the next 2 to 3 years for longer term buying. Those guys have been a bit uncertain about what the environment's going to be like, where they're going to be allowed to buy uranium from. So I think until some of those things are resolved, and we're sort of still waiting on a bit of that news to come out hopefully the next month or so, that's probably the first step. And then we've got Cameco as well, who need to buy a lot of volume in the spot market, and they haven't really been there yet. They've said they've got time and they're going to be selective. So yeah, again, it's hard to pick when it's going to happen, as it is a very opaque market. But certainly medium term, that's my top pick.
Fantastic. I mean, I think at pretty much every conference we've had for the last 3 or 4 years, somebody on the panel has said uranium.
Yeah, and that's the problem. And sort of I've been saying this for 12 or 24 months as well. So definitely been too early, but you can see the light at the end of the tunnel there.
Well, you'll be pleased to hear that there are people who've been earlier than you. It's all good. Rick, what do you think?
Yeah, I agree with Julian. I really like lithium. I think the next phase of the boom will be very different to the first one. That we saw a lot of small guys get up into production, and I think it'll be a lot more difficult for the point that the guys have said already, that raising big licks of capital is going to be difficult, and so what we'll see in the next phase will be just those big guys getting bigger, because you've got to really remember with lithium that this is a bulk commodity. They mine this stuff at 1.5%, and then they concentrate it up to 6%. So what's that mean? 94% is waste that heads off in the ship. So this is a bulk commodity. You can have a really good project, but if it's in the middle of nowhere and away from infrastructure, it's going to be very difficult to get that to market. And we look at that when we look at these projects, and it's not just the capital; it's the ability, the logistic chain to get that up, and we're really starting to see that now in terms of the problems some of these companies have got in terms of where they are remote and they're away from infrastructure. That it's more difficult for some of those guys to then build the refineries on the back of those operations. So you've got to think through the process in terms of where is the deposit located, as much as what are the qualities of that deposit. So I think the boom will be very different this second time around. But for in terms of the fundamentals, they're fantastic, and it's really exciting. So copper, as Andrew mentioned, that there aren't too many high quality projects sitting there that are mothballed and ready to go, unless they are really large capex projects. So that barrier to entry is actually what makes it exciting too for anyone that is a producer. So the companies in our space we look at like Metals X, and there's just been a lot of pain there for the last 18 months or so. But it's probably getting to a point where they've got a world-class tin asset, or half of it at least, and then they've got Nifty, which has just been delivering pain. But if that comes out of its problems, comes out of the clouds in the next 6 months like they're forecasting, well, that could be that's the sort of thing that could be exciting, and those barriers to getting new projects getting them on quickly is what makes it exciting. For nickel, I'm less optimistic. I like it as a commodity. I like the potential, particularly in terms of the EV story. But you just look out there in terms of how much mothballed production there is out there, and there's an enormous amount that's sitting there. There's the vagaries of what the Indonesian and the Filipino governments will do in terms of supply, and that's the thing that just sort of just holds me back a little bit in terms of saying that's an exciting commodity, whereas the other ones I think there's less control in terms of the supply, and so we're always mindful of that. So yes, we do invest in nickel, do like it, but won't be going really long. High conviction on that. So, and then as we mentioned at the start, you've just got to have gold there, because we don't profess to knowing the commodity prices are going to do. So it's like the insurance policy that sits in there. So just making sure that you've got some gold in there is that insurance policy, and then copper, nickel, and probably copper, lithium, and probably nickel are the other three.
Fantastic. At this stage, do we have any questions from the audience? We've got at the back here. Can we get a microphone around there?
I guess on the macro side, I guess most of the panellists have sort of talked specifics commodities rather than general macro, and have been sort of worried about the Chinese-US relations. I guess there's some suggestion that the Chinese are starting to worry about their own economy now, and that maybe we'll see quantity come back rather than quality. Is that how do you sort of process that through your thought process, and is that actually good for, say, bulk commodities in a way that we haven't seen for a while outside dams collapsing in Brazil?
Yeah, thanks, Graham. Look, I think you're right. I think the macro is very hard at the moment. There's a lot of moving parts. You've got the president of the US who's completely unpredictable and has a different agenda to, I think, what previous presidents have had. And when you've got the biggest economy that is a little bit more volatile, that makes things highly uncertain. So our view of the world, though, is in quite simplistic terms, and we could well be wrong because we're not macro stock pickers. But Andrew suggested they're highly uncertain about the outlook. We're, I guess, a bit more bullish. We think the markets are making new highs for a reason, because we've gone through a mid-cycle slowdown. You're getting rates getting cut all around the world, which is generally very supportive of global growth. You've got a trade war, which I think has frozen up a bunch of markets, which we think will thaw. Rick mentioned it'll probably be a gradual thaw, which is probably true, but I think gradual thawing in that relationship will be better than continual freeze in that relationship. So overall, I think the macro is quite accommodating, or the outlook for the next couple of years is quite accommodating. And then you've got China, which is clearly got a bunch of structural issues that they've been sweeping under the rug for a long period of time, and I'm assuming they can continue to do that. They must have quite a big rug to hide things under, but they continue to shuffle things under. And at the end of the day, they need growth to keep their population happy. There is a lot of income disparity in that country, and I think to keep the people happy, they need growth higher than where they've got it at the moment. So I think there is incentive for them to get some sort of trade deal or a staged trade deal, and also just incentive for them to open up a bit more stimulus. And I think we'll probably see some targeted stimulus over the next year or two to support that. So in the context of where markets generally go up, not down over time, given the position of rates at the moment, and I think the willingness to stimulate economies around the world, for us it looks more likely that the macro is going to improve rather than get worse over a period of time, and that does colour the way we look at markets. I think you're right, the bulks look relatively good. Gold, I think, has run on a lot of uncertainty where we've never been gold bugs, but we see a good place for gold in every portfolio, but I don't think that's going to be the one from our point of view that's going to outperform. It's going to be things like the general commodities like copper and zinc and the like, which are more industrially linked.
I wanted to, thanks for the question. We'll take a couple of questions more, but I wanted to talk a little bit about ESG. It's a big issue for your considerations for making investments at the moment. Rick, do you want to tell us a little bit about how you factor ESG into your investment decisions?
Sure. So at Acorn, we're a microcap fund, but we still get feedback from the superannuation funds and the funds that provide our funding. So it's really becoming important that we for a two-way process, understanding what it is that they want, what are the shareholders putting pressure on those funds to deliver, and also how the companies are delivering. And a nice example of what the companies are doing is Prodigy Gold. It's a little Greenfields Explorer, and they put out their last quarterly, and they actually had an ESG heading, and in their last quarterly, and they talked about how they went and did just a few basic things. They just did some, rehabbed a few drill sites. They had some owners meetings with the traditional owners. They talked about the communications they'd had with the different groups, and also what they were doing in terms of employment. So these are all things that companies have been doing for decades. Yet it's not known beyond sort of the people in this room, and so there's a lot of good work that's actually been done in that area, yet it's not communicated into the market. And so I was at the IMARC conference in Melbourne the other week, and sure, that was the lunatic fringe there, but a lot of those people are getting sympathy because they just don't see, there's no mechanism for recording what the really good work that's actually been done, and it's not as though it's new. This has been done for years, and you can see, you go back and have a look at any company presentation for the last probably 10, 15 years, and particularly the ones working in third world countries, you'll see about the community work that they've done. They've built a school, they've built a church, they've built a bridge, employment programs, whatever. So all these things are being done, but as an industry, we're not actually communicating that very effectively. And so what we are starting to do now is actually to talk to our the companies we invest in, and make sure that they communicate this thing. And so it's not just something that BHP needs to do, but it's everyone down to the little prodigies and the small explorers, that they've got to put this information out just to tell us more about what they're doing. The other side is we've also got to be talking back to those funds, because sometimes there's a misunderstanding of what the issues are. And the classic is coal, and they say, coal's bad, and we're saying, yeah, but there's coking coal, and coking coal's used in steel production. You can't use it without it, and steel's the backbone of pulling people out of poverty in places like China and India. And so we tell them the importance of coal, and they're going, oh, okay, I didn't realise that. And so then what are the mechanisms that are actually used to determine what is a good commodity and what's a bad one. So we're actually actively engaged with a group called Sustainable Platform for exactly that reason, so that we're giving them information and them feedback why certain commodities are not bad, and how they should actually how they can use that to determine their score, because at the end of the day they're coming up with a score to say whether we're a sustainable investor or not.
Absolutely.
Yeah, ESG is absolutely fundamental to what we do. Most of our funds is from the US, and ESG was hugely important to them 5 years ago, and it's absolutely fundamental to them giving you any more money going forward. So, for instance, at our AGM, we open up with an ESG panel where all our portfolio CEOs talk about ESG for the opening hour, and most of our LPs would view that as the most important part of the day. So that's before you even get to a discussion on fund performance. We're in the process of sort of refreshing our ESG framework and approach internally, which is a big undertaking. But I think the way we try and think about it differently is most people think about ESG as a way of stopping bad things from happening. So how to stop a tailings breach, how to stop a road blockage. We think of it as a value creator. That's why you do ESG, because there's so many positive impacts that can be derived from doing it properly. Social license is a term that's thrown around a lot, but that's just one part of it. So getting your ESG correct just opens up all these other avenues for you in terms of value creation that stem from, who you can possibly sell your project to, because you don't have that in-house. It'll be, the majors and the mid-tiers just will do their DD, pack up the bags and go home. So there's lots of angles to it. And to reiterate, I think we need to start thinking it as a value creator, not a minimizer of destruction of value.
Yeah, and a huge opportunity for the industry, obviously, with the move of what you would call it decarbonisation. I mean, obviously, steel is you need coke and coal for steel, but in general, the world is moving away from fossil fuels towards a sort of new energy future. Massive opportunity for the mining industry to supply the materials for that.
Yeah, agreed. I'll probably just add one other thing on the ESG side from our perspective. When I started AMP, we did a bit of work around ESG and said, well, it's nice to say you're engaged with companies in ESG and you're ticking the boxes and all that sort of stuff, but does it actually add value for our investors in the fund? And the work we did, we have an in-house team of 5 ESG specialists who sort of work across all our funds and help us out. They basically found that having, especially on the governance side, is very important. So having independent boards, having diversity on the board does actually add value, and you can show that companies with proper governance structures and good ESG practices do outperform companies that don't take that seriously. Things like having oversight of management team from an independent board, having diversity of thought, different experiences, and difference of life experiences and different backgrounds on the board does really help companies set up that framework properly. From our perspective, we are coming into investment, especially in the junior resources sector, where companies go from exploration to development to production often fairly quickly. We don't expect companies to be fully set up on the governance side. So we are happy to talk to management teams, say, we'll put you in touch with our ESG guys, we'll have a chat, we'll get them to tell you what we see as best practice, where you can potentially improve, and hopefully take them on that journey. And I think the companies that sort of get that and are willing to engage really do better for us to stay part of our portfolio for a lot longer.
Fantastic. Unfortunately, we have run out of time. Peter, I know you had a question there, but I'm sure you can grab the panellists afterwards. Matt mentioned diversity there, and we have a very not a very diverse panel, I have to admit, but they had some fantastic insights there. Thank you very much. For our panellists, can I have a big round of applause?